Hey folks, welcome back to Wealth for You, the channel where we break down investing for real Singaporeans like you and me. Before we start, quick milestone check. In just 11 months, we've published 252 videos, reached more than 3,300 subscribers, crossed 330,000 views, and accumulated almost 24,000 watch hours. But here's the thing. We can only reach more Singaporeans and help them gain real financial knowledge with your help. So please, smash that like button so this video can reach more Singaporeans, hit subscribe, and turn on the notification bell so you won't miss our next update. The more likes you give, the more people can get ahead financially. And we at Wealth for You would like to wish all a very happy National Day. Now, this video is actually requested by one of you in the audience, and it's about a stock that literally powers your Netflix streaming, your online shopping, your work Zoom calls. Basically, your entire digital life. Yup, it's NetLink NBN Trust. They just released their Q1 FY26 results for the quarter ending 30th June 2025 a few days ago. So let's dig in, see how the business is doing, the dividend outlook, and whether it's a buy, hold, or sell. Disclaimer: this video is for education and entertainment purposes only. It's not financial advice. Always do your own research before investing. Chapter 1. What is dividend investing? Dividend investing is all about buying companies that pay you regular income, like rental, but from shares. Instead of selling your stock to make money, you hold it, collect the dividends, and let the capital grow over time. For Singapore income investors, it's like Kopi money, or Kopi and Kaya Toast money, that comes in every 6 months or every quarter. Chapter 2. Singapore's Digital Backbone. NetLink NBN Trust is the quiet giant that owns and operates Singapore's nationwide fiber broadband network. We're talking about the entire backbone, the underground ducts and manholes, the miles of fiber optic cables, and the central offices that make sure high-speed internet reaches almost every single corner of our island. If you live in an HDB flat, a condo, work in an office, send your kids to school, or get treated at a hospital, chances are your internet runs through NetLink's infrastructure. They IPO'd on 19th of July 2017. And it was Singapore's biggest IPO in 6 years at that time, raising about 2.3 billion Singapore dollars. Here's the thing. Without NetLink, there's no Netflix, no Shopee, no Grab Food, no PayNow. Even your favorite hawker stall that now accepts QR payments needs their network. Think of them as the digital plumbing of Singapore. Invisible most of the time, but absolutely essential for our day-to-day life and for keeping our economy connected. Chapter 3. Q1 FY26. Financial Results. The Report Card. Alright, now that we know what NetLink does, let's open up their latest report card for Q1 FY26. That's from 1st April to 30th June 2025. First, the top line. Revenue came in at $102.8 million. A modest 1.9% increase from last year. That small bump was mainly thanks to more installation jobs and project work. Think new buildings being connected, smart nation upgrades, that kind of thing. Next, we've got EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. In simple English, it's like looking at the company's operating profit before the accountants subtract all the non-cash and financing costs. It tells us how much the core business is actually making from its operations. For this quarter, EBITDA was $72 million, actually down 1.9% from last year, because costs crept up and ate into margins. Speaking of margins, their EBITDA margin, basically how much of every dollar of revenue turns into operating profit, is still strong at 70%, but a touch lower than last year's 72.7%. Now for the bottom line. profit after tax dropped 9.2% to $23.3 million. The main culprit? Higher depreciation from all the new assets they've been adding to the network. That's the thing about infrastructure. When you invest in new equipment, the accounting charges go up, even if your cash flow doesn't take a direct hit. On the connections front, it's a mixed picture. Residential connections dipped slightly to 1.5 million as telcos cleared out inactive accounts. Non-residential numbers also eased a bit from customer churn. But the bright spot? NBAP connections. That's non-building address points like traffic cameras, lamppost sensors, and public Wi-Fi. Plus segment connections both grew, thanks to Smart Nation projects rolling out across the island. So in short, revenues inching up, profits are feeling the squeeze from costs and depreciation, and the growth momentum right now is more on the enterprise and government side than in households. Chapter 4. Key Metrics and Valuation. Is it worth the price? Now for the numbers that help us decide if NetLink's price makes sense for an income investor. As of today, NetLink's market capitalization is about 4.2 billion Singapore dollars. The price-to-earnings ratio is roughly 36.8 times. This is quite high, especially for a regulated utility-style business with slow growth. It suggests the market is pricing in future earnings, or investors are paying a premium for its stable, defensive nature. Its price-to-book ratio is about 1.46 times. This means the market values the company at nearly 1.5 times its net assets on paper. Their net gearing or debt-to-equity ratio is low at about 20%, giving them a very comfortable and healthy balance sheet. As for free cash flow, it has fluctuated. For financial year 2021, it's $206 million. For 2022, $178 million. For 2023, $189 million. For 2024, $174 million. And for 2025, $115 million. The trend is a bit choppy, but shows a general decline in recent years, primarily because of increased capital expenditure on maintaining and upgrading the network. NetLink's valuation presents a compelling paradox. While the company's low debt and stable business model suggest a secure investment, the high PE ratio of 36.8 times and a concerning trend of declining free cash flow paint a different picture. For a company with modest growth prospects, this valuation premium is difficult to justify. It suggests that investors are either willing to pay a high price for stability or that the stock may be overvalued. The decreasing free cash flow, driven by increased capital expenditures, further complicates the investment case, raising questions about future dividend growth and the true profitability of its operations. In short, NetLink may not be the bargain its predictable nature suggests, and for an income investor, it currently appears priced for perfection. Chapter 5. Dividend History and Sustainability. The juicy part. All right, my fellow income investors. Let's get to the juicy part. Dividends. NetLink has been a steady payer since its IPO, dropping cash into investors' pockets twice a year. The growth has been slow and steady. No fireworks, but dependable. In financial year 2025, the total payout was 5.36 cents per unit. At today's price, that works out to a trailing yield of about 5.96%. The forward yield? Pretty much the same at 5.96%. So you're looking at a consistent income stream if nothing changes. But here's the eyebrow raiser. The payout ratio is around 246% of earnings. That means, on paper, they're paying out more than twice what they actually earn. Now, before you panic, here's the nuance. For a business like NetLink, dividends are really supported by operating cash flow, not just accounting profits. And yes, the cash from operations does cover a big chunk of the payout. The challenge? Free cash flow. That's the cash left after paying for network maintenance and upgrades, has been shrinking, And to keep the dividends flowing and maintain the network, NetLink has been dipping into borrowings to fund its capex while still rewarding unit holders. Because gearing is low at around 20%, they can get away with this for now. But long term, you can't keep topping up the dividend jar with borrowed money forever. At some point, either free cash flow has to rise, maybe through higher regulated tariffs or lower capex, or the payout will need to be adjusted. So yes, the dividends are safe for now. But if you're holding for the next decade, you'll want to watch that free cash flow trend like a hawk. Chapter 6. Critical Evaluation and Future Outlook. All right, let's step back and take a balanced look at NetLink. First, the positives. This is an extremely stable business. Every home, office, school, hospital, basically anywhere you can think of in Singapore, needs a fiber connection. That makes NetLink part of our country's critical infrastructure. People can change telcos, but the fiber under the roads? That's still NetLink's. Their low gearing, just around 20%, gives them a very comfortable financial cushion. Cash flows from operations are steady and predictable, thanks to their regulated revenue base. And while the residential and non-residential connections are mature markets, there are growth pockets, especially in NB-app connections, so think smart nation sensors, public Wi-Fi, and surveillance systems, and enterprise connections for offices, industrial sites, and data facilities. But of course, not everything is rosy. This quarter, profits fell 9%, reminding us that even regulated monopolies aren't immune to cost pressures. Higher depreciation, operating expenses, and maintenance costs can nibble away at margins. There's also been a slight drop in residential and non-residential connections, mostly due to account cleanups and churn. While the declines aren't alarming yet, they show that the core markets aren't really growing anymore. The bigger red flag for income investors? Free cash flow has been trending down for several years. That's largely because capex, the money they must spend to keep the network in top condition, has been rising. And that means less spare cash to grow dividends over time, unless something changes. Looking ahead, the future prospects are still solid, just not explosive. Smart Nation 2.0 will need thousands of new NB-AP connections for things like autonomous vehicle sensors, smart lampposts, and public connectivity. 5G backhaul, the fiber links that connect 5G base stations to the core network, is another steady demand driver. Data center connectivity is becoming more critical as Singapore positions itself as a regional digital hub. An encouraging sign is that non-regulated revenue streams, like installation work, co-location services, and ad hoc projects, are growing faster than the core regulated income. These can improve margins because they aren't capped by the regulator. That said, this is still going to be slow and steady growth, not a tech stock rocket ride. NetLink's role is more like the dependable MRT of Singapore's internet, not the Formula One race car. Final thoughts. Buy, hold, or sell. The verdict. So, is NetLink a buy, hold, or sell? If you already hold NetLink, I'd say hold. Keep collecting that roughly 6% yield, enjoy the rock-solid stability, and think of it like your internet bill in reverse. Instead of you paying for broadband every month, NetLink's paying you. But if you're new and thinking about buying in, here's my advice. Don't rush. This isn't the kind of stock that's going to shoot up overnight. NetLink is a bond-like investment. Its main job in your portfolio is to provide steady, predictable income, not fast capital gains. And with income stocks like this, timing is everything. You want to buy when the price is attractive, so you can lock in a higher yield for years to come. Right now, based on the price earnings, price to book, and falling free cash flow, the stock feels fair to slightly expensive. Definitely not a screaming bargain. Think of it like signing up for a long-term broadband plan. You want the best deal up front because you'll be living with it for years. Same here. Wait for a dip, let the market hand you a better entry yield, and then sit back to enjoy the income. Patience really pays with these steady dividend counters. Those rare dips, maybe during market jitters or interest rate scares, are your golden chances to lock in an even fatter stream of passive income for the long haul. So that's the breakdown of NetLink NBN Trust's Q1 FY26 results. If you found this helpful, please give it a thumbs up and subscribe to Wealth for You. It really helps more Singaporeans discover these videos. In the past 11 months, we've published 252 videos, reached 3,300 subscribers, accumulated almost 24,000 watch hours, and crossed 330,000 views. And we can only keep growing with your support. The more likes and shares this video gets, the more Singaporeans can learn how to invest smarter and get ahead financially. So, here's my question for you. Are you team steady income like NetLink or team growth stocks? Drop your answer in the comments. I'd love to hear your thoughts. Thanks for watching and happy investing. And once again, Happy National Day, Singapore!